Hello, everyone. Welcome to the TBR webinar series. We're going to start today's webinar in just about a minute to allow folks that are straggling on to log on and get themselves set and get ready. So hold tight for just about another 50 seconds, and then we'll get started. Thank you.
Hello, everyone, and welcome to the TBR webinar series. Today, Practice Manager Patrick Heffernan, Principal Analyst Boz Christoph, Principal Analyst Jeff Willicott, Senior Analyst Elitsa Bakalova, and Analyst John Kroll will be presenting the webinar with IT Services Again Enabling Digital Transformation, DeFi Shifts Blockchain into a Higher Gear. Before we get started, just a few housekeeping notes. At the bottom of your screen, you'll see a series of buttons. From left to right, you can access the slides, audio controls, Q&A, speaker bios, survey, information on the next webinar in our series, including a registration link, an exclusive free trial offer for folks on the webinar who are new to TBR, and a related content widget where you can download the slide deck and access other related materials. These buttons at the bottom of the screen allow you to minimize each window to customize your webinar experience, and you can also maximize the slides if you wish to view them in full screen. After the webinar, you will receive an email with a replay link, as well as a link to view and register for other TBR webinars. If you have any questions for us, please submit them via the Q&A widget in On24. You may also reach out to us after the webinar at webinars@tbri.com. Thank you again for joining us, and here's Patrick to begin the webinar.
Excellent. Thanks so much. And Haley mentioned the whole team that we've assembled today. So we want to do some quick introductions so you understand who everyone is, what their voice sounds like, and where they're coming from, the perspective that they're bringing to this particular topic. So I'm Patrick Heffernan. I am a principal analyst. I run the professional services, IT services, digital transformation portfolio here at TBR, covering the broad expanse of things, which allows me to see a lot of different areas, cover a lot of different things, and you've probably heard me on a lot of different webinars. And Elitsa, why don't you introduce yourself next?
I'm Elitsa Bakalova, Senior Analyst in TBR's Professional Services team. I am the expert and lead analyst on Atos, Capgemini, and IBM services, and I also lead our IT Services Vendor Benchmark, which is a quarterly publication and includes 30 vendors from the IT services space. Boz, on to you.
Thank you. My name is Boz Christoph, Principal Analyst in Professional Services Practice, lead the research on digital transformation, which we're going to talk a little bit more about today, including blockchain, as well as global delivery and automation. I also lead the research for Accenture, Deloitte, KPMG, and Infosys. John, over to you.
Hi, everybody. I'm John Kroll. I'm an analyst with TBR in the Professional Services Practice, and I cover a few companies, TCS, Tech Mahindra, CGI, and I also support work on a few other companies and benchmarks, including the IT Services Benchmark. Jeff?
Hi, I'm Jeff Willicott. I'm a principal analyst in our Tailored Services group, which is where we do our custom engagements, which can range from taking a look at legacy business models like third-party maintainers and how they're starting to disrupt and get the attention of large system vendors on the maintenance base, to emerging topics, which is things such as blockchain, which I've been at least keeping an eye on for the last 5 years, quantum, where I contribute to the market landscape, which is a syndicated product we have, and anything and everything in between, depending on what people ask for, either internally or externally. Patrick?
Thanks. And I think, as you heard, with the exception of Jeff and myself, everyone told you which vendors they cover, and that is because at Technology Business Research, we do take a very vendor-specific lens when we look at the market, starting with what the vendors are doing. And we're going to go into a lot of detail on that. You're going to hear a lot of different vendor names and examples, and if you have questions, please throw them into the Q&A widget, and we'll get to them at the end. So what are we going to cover today? This webinar, in many ways, is like one of those double helixes, if you think about it. There's going to be one strand that's going to be all about IT services, starting with what's been happening by looking at all the companies' benchmarks. We're going to take a deeper dive specifically into what's happening around IT services, vendors, investments, and activities in Asia-Pacific region. Then the other strand of that helix is around blockchain and DeFi, and we're going to try and get past the hype around cryptocurrency. We're going to try and talk more about what are the specific kinds of services, or more importantly, what are the different kinds of investments and the ways that the services vendors and the others that we cover across the IT services space and the cloud space, what are they trying to do in blockchain? What are they trying to do with DeFi? So let's get beyond the hype and not talk about, the latest piece of news that's come out, but really talk about where the investments are being made and what they're trying to do, how they're trying to help their clients understand blockchain broadly, and then some of the opportunities in DeFi specifically. So supporting this is our research in these areas. So you can see the IT services vendor benchmark mentioned there does come out quarterly. The next one will be coming out sometime soon, covering the third quarter of 2021. It always lags a couple of quarters as we pull together all the financial reporting from the vendors that we cover, and Elisa can give all the details on who those vendors are and how we structure that. But then we also have twice a year a market landscape looking at blockchain. Again, it's within the digital transformation part of our practice, and it really is looking at blockchain not as a technology, not as an emerging technology, I should say, but blockchain as part of digital transformation, and blockchain as part of the solutions, part of what the IT services vendors and the consultancies are bringing to their clients. So that's the sort of mindset, the framework that we bring into looking at blockchain. So we're going to cover it from that perspective as well. And we'll weave the two things together, what's happening in IT services and what's happening in DeFi and blockchain together throughout the webinar. Again, if you have questions, throw them in. We'll get to them at the end. And with that, let me turn it over to Elisa.
Thank you, Patrick. So let's begin with the first topic on our agenda today, which is the performance and the key trends that we identified during the first 9 months in 2021 for the 30 vendors in the IT services vendor benchmark. We published our latest IT services vendor benchmark in October, and on this slide, I want to highlight 3 key trends that were identified in our analysis. So the first trend is about secure hybrid IT. The COVID-19 pandemic drove an increased demand for secure hybrid IT, and we're seeing many clients pursuing operational efficiencies through cost-effective and platform-based solutions. Hybrid cloud is really taking a center stage in transformational activities, and multiple vendors are expanding their offerings, and they're also developing certified talent to enable those hybrid cloud models. Security has really become a mandatory piece in transformations, and especially during the rising occurrences of cyber attacks and data infrastructure, and especially with the hybrid working models and people working from home. So protecting data and infrastructure is really key. IT infrastructure modernization remains a significant driver for vendors consulting and systems integration revenue and activities, and IT services providers use those investments in cloud portfolios and resources to advise and implement cloud migrations and cloud-based solutions at scale. The second trend is about acquisitions. Consolidations in the IT services industry has been going on historically well before the pandemic, many years for now, and we have seen multiple large-scale mergers and smaller-scale and mid-sized transactions throughout the years. But a trend that has been specifically accelerating over the past year is the increased number of small to mid-sized acquisitions that IT services vendors are making to expand specifically specialized skills and to supplement portfolios and to fill in gaps. The skills, they can range from industry specialized expertise, skills around data and AI, also skills around partner technology, such as, for example, Salesforce, Google Cloud, and SAP. Vendors are also acquiring consulting and implementation resources. And specifically expanding front-end consulting capabilities enables IT services providers to position closer to clients, to understand their business and technology needs, and to deliver business outcomes leveraging technology-enabled transformations and innovation. And I really want to call out one vendor as an example. I think Accenture, by far, has been the leader in making acquisitions. The company announced 46 acquisitions during its fiscal year 2021, which ended in August. And, you know, it's been going on for a while, this activity, and Accenture is really utilizing its command and control culture to execute successfully across growth initiatives and across acquiring and integrating companies. And while Accenture's acquisition strategy continues to revolve largely around small-scale tuck-in purchases, we're seeing that the company has started to spend more on bigger buys, mid-size acquisitions such as the ones of Umlaut and Novetta, each with a $1 billion plus price tag and thousands of employees that were added to Accenture. So this kind of suggests that the company is trying to accelerate and shift its acquisition pace in favor of more mid-size acquisitions, and to take advantage of market consolidation, and in this way to stay ahead of competitors to recruit top talent and gain resources. And the third trend is about increased employee utilization and attrition. We're seeing a steady increase in employee utilization and attrition, both sequentially and year to year, in 2Q21 and also now in 3Q21 as companies are releasing their financials. While hybrid and remote working models are viable options for IT services vendors during the pandemic, those models are pushing employee productivity to the limit because people are now working prolonged hours at home, and this is really becoming a common practice. Digital burnout is really common across employees of IT services vendors. Blockchain solutions are being leveraged as a productivity accelerant and another way to drive utilization. And we'll later in our presentations hear from Jeff and Boz about blockchain. With the gradual alleviation of pandemic pressures, we see employees starting to seek new job opportunities. And this is driving an increase in attrition in the past 2 quarters, in 2Q21 and in 3Q21 specifically. Also, vendors have started to launch hiring campaigns to fill resource benches to address rising demand for digital transformation, which in turn is driving talent poaching from competitors and increasing employee attrition. I'll pass it over to John now, who will dive deeper into employee utilization and attrition on the next slide.
Thanks, Lisa. Just to orient you to the slide, you can see we have the average employee utilization and attrition over the last 3 years for the benchmark vendors plotted down below. And so we'll start with utilization. It's at its highest point it's been in the last 11 years at 80.7%, up 90 basis points year to year, which was already above the historical range of between 72 and 77%. So even before the pandemic, utilization was up, and it only proved to accelerate after vendors went remote in 2020 and demand for IT services boomed. On top of that, automation is increasingly becoming table stakes. So accelerators and tools to automate aspects of delivery are being leveraged more frequently, and that's providing a boost to productivity. But it will put pressure on vendors' low-cost services models with those automation savings being passed on to the client. And like Elitza mentioned earlier, digital burnout, long hours, and at home, these things really can't be ignored for the IT services vendors. And that is causing attrition to rebound really from the low points where it bottomed out over the last few quarters. It jumped 210 basis points year to year and 200 basis points sequentially this quarter. So both of which are the largest increases either year to year or sequentially in our database. Very unusual, a very sharp rise, almost equal to the decline at the start of the pandemic. And that indicates to us employees having time to rethink their career paths, and along with vaccine rollouts and better macroeconomic conditions, employees are now re-entering the job market and compelled by attractive options, either with startups, tech companies, or other entrepreneurial endeavors. And as we know, vendors are at the same time hiring aggressively and poaching talent to meet the very broad-based demand that we're discussing. Now, attrition is actually still below pre-pandemic levels. It's down 80 basis points from 2Q18. So at a glance, it goes against kind of what we're hearing about the Great Resignation or the Big Quit when you put it in that perspective. But so far, by the way things are shaping out in our syndicated 3Q21 coverage, there are examples where this acceleration really isn't done yet. Accenture at 19%, Capgemini 19.5%, Infosys at 20%, and Cognizant at 37%. Again, these are for 3Q21 so far. So we'll have to wait and see the final 3Q21 results in December. But from what we're seeing and hearing from vendors so far, it's that attrition is going to continue moving upwards. And on top of that, like Elisa was mentioning, it's been a hot year for acquisitions, really with no real signs of slowing down. And as we know, there's often a high level of churn associated with M&A, and that could combine to be another driver. It's worth pointing out Cognizant here as an example of sort of the risk that some vendors run if attrition goes uncontrolled. 2 consecutive quarters now, Cognizant has been over 30% attrition rate, and noted that it's left money on the table and hasn't been able to deliver on projects in some cases due to staffing shortfalls. Another factor with such high attrition, recruiting freshers, which is especially important for the low-cost services model, that becomes less effective with vendors needing workers to really hit the ground running and already be trained in the areas that they need them. So vendors have focused on building, vendors that have focused already on building a large bench and a talent pipeline, they may be holding on for the time being, but could still end up competing more to retain the mid-level workers in the coming quarters. And, digital burnout, again, that's not going away. The combination of skill shortages, increasing demand, and now rising attrition is generally leading to overworked labor bases. Plenty of examples exist of companies trying to address this by deploying virtual or contactless solutions, thinking like virtual yoga or counseling or AI tools for training and upskilling their employees. But it's unclear if those are going to have much of a long-term benefit. And so we may see a rebalancing of pay scales or companies being more vocal about benefits and work schedules. But really what we view as being the difference maker here in retaining employees is ultimately culture, especially for companies with traditionally long hours or micromanagement that now have to appeal to a new generation of workers where work-life balance is starting to take precedence. And finally, many companies are mostly remote still, and we're starting to see now plans to return employees to the office or to take some sort of hybrid approach. TCS, for example, after all the hype it built around hybrid working and its 25 by 25 vision, it announced this quarter that it's planning to bring 90% of its workforce back into the office by the end of the year or early next year. While TCS does have consistently below benchmark average attrition rates, it's something that we're going to keep our eyes on how that return and in-person resonates with the workforce and how that may affect attrition or retention, and also how the relationships with clients will or won't change. And that really goes for companies across our coverage as well. And so with that, I'm going to turn it over to Elisa now to go over more on the demand and more on the client side and our estimates for revenue and all the trends that we've begun to talk about.
And real quick before we go to Elisa, we've used Alita, let me just jump in real quick. We've used this platform before, this on 24, and the last time we tried to do a polling question, we had some trouble. So we're shied away from polling questions, but based on having attrition and this discussion of it really up high here in the webinar, one of the first things we're talking about in depth, I would love it if people, if you have a chance and you can put some comments in the Q&A box. It doesn't have to be a question, it can just be a comment about attrition and whether or not you're seeing it as such a priority and such an important marker of where these IT services vendors are and the struggles that they're going through or the challenges that they have in this market right now. So just a little request, if you can throw some comments in the Q&A box, that would really help us out. Now, back to you, Alita.
Thank you, Patrick. So on this slide, I want to just provide the kind of tie in the trends with the data that comes from the 30 vendors in the IT services vendor benchmark. And this graph is based on annual figures for those vendors that are in the benchmark. And provides our historic data and our expectation for 2021. So we're expecting an acceleration in IT services revenue growth for the 30 vendors, and that growth will to reach 6% year to year in 2021. We have one more quarter to go, so we're getting closer to our closing on our estimate. As you can see, this growth will slightly surpass the 2018 revenue growth that was reported for the 30 vendors. And while the pandemic remains an external factor that can negatively affect IT services spending, subsiding pressures due to the global vaccine rollouts indicate a potential revenue growth acceleration for the 30 vendors in the benchmark for the full year. Additionally, growth initiatives such as around product engineering, supply chain improvement and sustainability, and steady investments, especially in hybrid cloud, AI, security, IoT, blockchain, and industry specialized offerings, continue to expand vendors' addressable market opportunities and drive revenue growth for multiple vendors in the benchmark. Notably, we saw an acceleration in cloud and cybersecurity activities. Those two areas really took a center stage in many buyers' digital transformation agendas in 2020 and continue to support growth, revenue growth during the first 9 months of 2021. And as we move into 2022, revenues will be driven by a mix of 3 activities. The first is around development of short-term projects around operational resiliency and running businesses. The second is around larger transformational engagements that enable clients to improve their business models. And the third is around innovation engagements that allow clients to do something really completely different, to change their business model completely. And all those 3 activities will be supported and enabled by technology solutions and services that we called out, such as cloud and AI and cybersecurity, IoT. If we move to the next slide, we provide the positioning for the 30 vendors in the benchmark. The landscape is very diverse, as you can see, in terms of size. The bubble size is the annualized revenue for the vendors, growth and profitability. But we can clearly see where the leaders are, and they are the top right corner of this graph, and where some of the more challenged and the revenue growth laggards, which are at the bottom and the left side of the graph. So we want to add a few vendor examples here to our discussion, and I can start with one vendor, Capgemini, which is an outlier. There's no bubble for it on the graph because Capgemini's revenue growth on a trailing 12-month basis have been exceeding the average. And the reason for this is the Altron acquisition, which was integrated fully in 1Q21. So we still see on a trailing 12-month basis, we still see the inorganic contribution from the Altron acquisition to revenue growth. But Capgemini is really on track to further improve its financial performance on an organic basis. The company is enriching its portfolio by scaling in digital and cloud and AI capabilities. It's launching new offerings around sustainability. It's also expanding activities with partners. And we're seeing a significant improvement in organic growth year to year. For example, in 1Q21, Capgemini grew revenues organically by 1.7% year to year. In 2Q21, that growth accelerated to 12.9% year to year. And in 3Q21, it reached 13.2% year to year organically. So the positive development in organic revenue growth led to a second upward revision during this year of revenue outlook for the full year and also operating profitability for the company for the full year. So we expect the company to still remain in the top right quadrant of the graph going forward. Boz, on to you.
Thank you, Lisa. And I just want to kind of provide some highlights on Infosys here real quick. Certainly standing out in terms of growth comparing to its peers in the benchmark. So Infosys revenue growth in the 2Q21 was the fastest on record for the last 10 years, just as Infosys reached its 40th year anniversary in terms of company existence. So a couple of factors that contributed to the growth for Infosys. The investments in digital, just like everybody else, have helped to bolster some of the higher value awards. But, if you kind of peel that back and see exactly what's underneath, it's really a lot of what Infosys has been doing for those 4 decades and really helping them be the vendor on the supply side that a lot of the buyers can trust and rely on. And really that's what is helping Infosys drive that double-digit growth. We also saw the momentum continuing in 3Q21 as they released their financials earlier in October. So in terms of the 2Q21, some of the other factors, the two of the larger industry verticals like financial services as well as retail, which recovered well for them, grew at really strong. Financial services was at 26.9%, retail was 27.1%, so close to 27%, both industry verticals growing. North America was at 21.6% and Europe was 22.6%. So really broad-based revenue growth across the firm. Some of the mega deals the company has signed over the last year, like with one with Vanguard and with Daimler, is starting to kick in and starting to provide some cash inflows and helping to bolster the top line for performance for Infosys, which is also enabling them to increase their revenue guidance trajectory and looking at the upper mid-teens for fiscal year 23 rather. So it's certainly a momentum we see in the market, and it's certainly ongoing investments of the portfolio around cloud with Infosys Cobalt, as well as cybersecurity and analytics. And more importantly, aligning the vision of the current leadership of the CEO and the board to the founder's vision of where the company should be has really played well in Infosys' favor and how they're able to go to market and execute on their true core value proposition on the services supply side. So certainly Infosys, we see Infosys continue to win share in the market and expand its value proposition through strategic investments at the way it plays well and where it's well known by its customers. I will now turn over to John. John?
Thanks. I'm going to go over TCS now. I'll talk about its 3Q21 numbers a bit here since we just reported on it, but it really does sort of match where they're on in the bubble chart right now. So it was another good quarter for TCS. They achieved revenue growth of 16.8% and crossed $6 billion in quarterly revenue, and also maintained their operating margin within the aspirational range of at 25.6%. So for the company, talent is and has been a huge focus, and it's leveraging a strong pipeline of digital talent enabled through initiatives like its national qualifier test in India and partnerships with universities that are really global. These have helped it continue to hire fresh talent in bulk. It added almost 20,000 employees sequentially and over 75,000 year to year. So its ability to recruit at such a high pace compared to its peers, and its ability to maintain below average attrition, which was 12.5% compared to 16%, is really crucial for it to continue executing on the bookings that are ramping up. And those bookings were at $7.6 billion, the total contract value in 3Q21, and that's over $1 billion larger than the average for the last 2 fiscal quarters. So TCS is successfully capturing demand for a lot of the trends that we're seeing, especially like early on in the pandemic, the run the business and the outsourcing demand, due to its strong AI and automation capabilities and its large, low-cost, agile labor base. But we're also now seeing evidence that it's successfully taking part in larger, broader digital transformation engagements that have really been enabled by cloud and also crossing thresholds, AI, analytics, 5G and IoT technologies, and being the integrator and the connector of those technologies, tailoring to industry needs. So clients above the 100 million spending category increased by 5 year-to-year, and that's a metric that basically was stagnant throughout the pandemic. And so really it's investments in partnerships and digital talent and innovation are supporting the growth there. For example, it's been rolling out some new innovation centers, what it calls TCS Pace Ports, like one in Amsterdam, which this quarter it launched a TCS Google Garage at that Pace Port that will be sort of a touch point for innovation with clients and partners on Google Cloud solutions. And so those are attracting new business and improving the company's value proposition as an innovator, and really around digital engineering and robotics. For example, it engaged with a Swedish pharmaceutical company related to e-commerce and customer experience, looking to transform the physical and online sales channels using AI, automation, and IoT technologies. And similarly, partnering with the cloud and data partners, which the company now has a business unit for the top 3 cloud providers, Microsoft, Azure, and AWS, with AWS formalizing a couple quarters ago. Those are sort of complementing those innovation centers, like through the Google Garage, and also helping attract new business related to cloud, application modernization, and overall growth has been broad across industries and geographies, even in its home market, APAC, specifically working more with local India-based banks, leveraging its very popular bank's core banking platform. So I think that will be a good turning point for Litsa, who can sort of dive more into what vendors are doing in the Asia Pacific.
Thank you, John. So on this slide, I want to go over the second topic on our agenda, which is IT services vendors' investments and activities in Asia Pacific. So we're always looking for ways to enrich our portfolio and to increase the value that we provide to our clients. We've decided to add some level of details and deep dives each quarter into our IT services benchmark report. We're keeping the structure of the benchmark to be organized by service lines and geographies, but we're adding analysis that focuses on industries and geographies, which we alternate every quarter. So in 2Q21, we did a deep dive on Asia Pacific, and in 3Q21, we're planning to do a deep dive on financial services. This slide provides a summary of our analysis on the Asia Pacific region. As you can see on the graph, the pandemic-related activities pressured revenue growth, and the revenue growth slowed down during 2Q20, 3Q20, 4Q20, and 1Q21. But it began, regional revenue growth began to accelerate during 2Q21, supported by the gradual lifting of restrictions, with the vaccine rollouts and overall expansion of activities. We're seeing an increased interest from IT services vendors to expand their local market reach in Asia Pacific, so they can diversify their global revenues during 2022. Because as of now, Asia Pacific really is a region that's small in revenue size as a total percent of revenue, because it's mostly utilized for global service delivery to clients outside of Asia Pacific. So IT services vendors are ramping up activities around building local market resources to better serve clients that are based in Asia Pacific, or their global clients that have operations in the region. Vendors are establishing local resource capacity on top of their global delivery services resources that have existed for decades. And the common levers for local market expansion include acquisitions, hiring of local resources, and establishing joint ventures and partnerships. On the acquisition side, vendors are, in the past few quarters, they've pursued acquisitions in Japan, in Malaysia, Australia, and New Zealand, a trend that we believe has accelerated over the past year and shifted from gaining global delivery capabilities to building local market resources in areas such as digital, cloud, data, consulting, with the key focus to expand revenue streams. For example, vendors such as Accenture, Capgemini, Cognizant, Fujitsu, and Wipro, they all announced acquisitions in Australia in the past few months to support local market expansion in areas such as product engineering, digital marketing, cloud, consulting, and SAP-related capabilities. On the resource addition side, in continuation of an ongoing trend, vendors launch local offices. They also launched industrial and special design facilities to increase the value and expand client reach. They establish closer relationships with universities to drive innovation and to create a funnel of new and highly skilled talent. For example, quickly growing revenue leaders are eyeing opportunities to further penetrate the Asia-Pacific market by using digital design and creative capabilities to drive higher value opportunities in regions such as Japan and India. Accenture, I want to call out, which was number 5 in revenue size in 2021, announced the opening of an office in Japan to where it will host the Accenture Interactive Droga 5 team, along with plans to open similar facilities in Brazil and China over the next 12 months. Capgemini, which is number 15 in revenue size in Asia Pacific, is establishing a new network around Frog, which is the digital experience design consulting arm that came from the Altran acquisition and is now part of Capgemini Invent. Frog initially had one studio in Shanghai, but has expanded in Asia Pacific with studios in Singapore, Hong Kong, Sydney, and Melbourne, Australia, and also in India. Frog's Asia Pacific business focuses on industrial and special design, and it's tied with the new Capgemini engineering brand that was launched as a result of the Altran acquisition to drive experience and design that transformation. And the last item on partnerships, vendors are establishing joint ventures with clients to enable digital transformation and innovation across industries in Asia Pacific. We're also seeing vendors pursue joint business units with technology partners, especially the cloud service providers, to invest regionally and to be able to drive infrastructure and to provide that infrastructure backbone that's needed to support modernization in the region. I want to take a pause here and to move to the third topic on our agenda today, which is blockchain and decentralized finance, and to hand it over to Jeff.
Thank you, Elisa. The first thing here that you're seeing, and I won't try to endeavor to drain the entire cube, is a new way at TBR where we're trying to rationalize and make sense of all the different disruptors that are going on, both in the technology industry and then as a result throughout the rest of the economy and the different industry sectors. And it really is a fundamental change in how you view business, how you view business monetization, and it's really where blockchain can be the red thread that allows you to stitch it together in a decentralized way rather than in a centralized way. So if you take a look just at the top in terms of the value chain, you'll notice we lead at the sort of the top of that box with end users. Now those end users are either your workers, your employees, or your ecosystem participants, as well as the consumers in terms of how they want to ingest or what it is they're looking for, which also ties at the front of that to the value proposition component. And then you just have all the different stacks that need to be assembled from the technology enablement layer to deliver whatever this ecosystem offer is, which ties to the industry side of, is it an offer in healthcare for telemedicine? Is it an offer for a consumer product? And all of those are either messaged or worked on in terms of the value chain front end of this queue. Now, as you get into this, you have to start looking at the sub-level frameworks. And clearly the first one is the use cases. You know, the use cases are myriad in terms of who's automating what for whom. But at the bottom line of this, or the fundamental underpinning it, I'm sort of jumping over personas, are the business models. And this is where blockchain really has the ability to take hold. And what we've heard, I've been listening to various blockchain experts for years. Paul Brody at EY is far and away one of the more prescient of the blockchain experts I've been listening to over the years. He is very good in his predictions. He made a statement that your blockchain in and of itself is boring. It should become boring, just as cloud in and of itself is boring. It's you know, electronic access to compute. But in the early days, it was very, very important. I heard about it all the time. And now it's being sublimated to the use case. Well, blockchain in and of itself will get sublimated to the use case. However, because it is a fundamental rip and replace in one way of the technology architecture, if you have proven ways of getting it done now that aren't broke, right, why are you going to do it? So his premise is that it will take a new need or a new product category or a new regulation that can concurrently grow with blockchain to further cement its value in the minds of the enterprises. Now, they have a test case that they promote all the time that they did with Microsoft for the tracking of developer royalty payments for when games are sold. And they list how it used to take about 45 days to clear, and now they can do it in 4 minutes. They've stripped labor of 90 points. I have heard in the public sector, and that has a challenge too for blockchain, particularly for decentralized finance, in terms of establishing new regulations around trust. If the institutions are going to go away or not be the trust layer, but it's going to be this community trust through off-chain data that assures the seller in Asia that the buyer in the United States has it. And his point there, the analogy he used, was railroads and telegraph. That as railroads were building out a new way to travel, we needed a new way to communicate, which was to have the telegraph machine so you'd be able to tell when a train was on the track so you wouldn't have collisions. So from that vantage point, if you think of new use cases for blockchain, we're going to have new requirements coming on greenhouse gas emissions, and we're going to have a way to track that. Now, to try to simplify it, just think of you tap the buy it now on Amazon.com on your smartphone, and it triggers a multitude of events to get a product that you want to the location where you want it. And all you do is tap the button. All these things happen. It's largely electronic. It's largely RFID scanners. And you can get text message alerts of where it is and how it's going and on down the line. And then, you know, voila, there it is 24 to 48 hours later at your door or at the door you want it to go to. That's just for the physical movement. Now think of the general ledger record keeping that is automatically tracked, traced, updated as this unit of whatever you purchased is being moved through. So we can see it in terms of the supply chain. That was a way we talked about it in the most recent blockchain market landscape and took a look at supply chain. This time around, we went to decentralized finance. And decentralized finance is not a question of if, it's a question of when. It's coming. There are a lot of different people who are taking a look at it, a lot of different governments that are taking a look at it. Savvy centralized finance, CFI institutions are taking a look at a way to accommodate it and embrace it. They're talking about new investment mechanisms, investment values. We're talking about central bank digital currencies, CBDCs, or fiat coins, stable coins. You have the various speculative coins, the cryptocurrencies, Bitcoin, etc. The Economist talks about Bitcoin as a store of wealth on par with gold. So it's also sort of a way to, it's not just the currency trading necessarily or the currency transactions, although that is needed for the track and tracing to dovetail with the movement of the goods and services that we can do through these legacy ways today. But decentralized finance is just an augment and an automation layer to once again strip labor that isn't either a point of consumption or a point of creation within this cube of sort of an ecosystem value chain. And that is really a fundamental difference in how you evaluate your business. In technology, it is, if you think of all the different partner programs, it really is the big, large partner just dictates terms and that's the end of it. And they have all their little slices because legal has insisted they need to have this type of construct for this type of business entity versus that one. Well, if you're working in an ecosystem, you have to think about what's in it for the ecosystem. How can we simplify it? How can we strip labor out of it? And that is sort of a revenue sharing smart contract model. And with that comes the movement of money or the movement of value on more of a royalty sharing rather than this cost plus transaction and margin. And with that, I'll come up for air and Boz, see if there's anything you feel you need to clarify on what I just said.
Sure. Thank you, Jeff. Maybe we can just turn over to the next slide kind of to continue the story around decentralized finance and where really the use cases are we're seeing and how vendors are preparing for any sort of a short-term and long-term opportunity. So a couple of points here to make to expand on what Jeff was just talking about. The use cases are certainly mostly coming from the banks. And about 12 to 18 months ago, banks were really looking at crypto and digital currencies as a really fad. As part of our research, we started to seeing how and hearing the sentiment starting to change, and it's really about banks trying to understand where are the end consumers, the individual investors thinking, and how banks should not be leaving money on the table, because essentially decentralized finance goes against the core of banks, being the intermediary of funds exchange. So what we have heard and seen from banks starting to apply is really testing the water around decentralized finance and deploying blockchain platforms to really see how consumers behave, how they invest, what will be the risk profile of the future if and when, not if, but when kind of blockchain scales up, and really turn into that world where, you know, many banks agree and governments, it's really about developing more of a hybrid view of the world, not just centralized finance, but decentralized and centralized kind of hybrid value proposition between the two technologies. So those individual investors that the banks are really investing around, provide that risk-sharing profile, trying to understand before those banks can really scale up their investments. On the other side, scale up those investments with the institutional investors. On the other side, government and governments across the world are starting to pay a little closer attention, starting to think about and paving the way to a broader adoption, how it actually will work. We're seeing over 40 governments around the world going through various phases of experimenting, thinking around building central bank digital currencies. We know there's a project going on here in the U.S., Digital Dollar Project and Digital Dollar Foundation with the Federal Reserve behind it. We know a similar project and investments are going in Europe through the Digital Euro project. We know that China is already ahead of the curve, already not just researching it, but actually deploying digital currency and really trying to stay ahead of EU and the US for that matter. So there is a lot of motions. As one expert that we talked to described, it's really how can you make cash quick? And certainly there's a lot of messiness going on in the market right now, as we have kind of a call it out here, the headline on the slide. But with the decentralized finance, that it really provides a good opportunity to test the water for some of the key players like the banks, the financial services institutions, and then the governments to start thinking how they can better collaborate. What this does is it provides a strong opportunity for services vendors, for technology vendors to play to their core strengths, to their value proposition, to start to think how they can bring the Main Street economies and the Wall Street economies. Where are some of the opportunities they lay for them? Certainly, the consultancies are in a favorable position when it comes to governance and advising. We see Accenture being a vendor who is actually involved heavily with the Digital Project Foundation that I mentioned. We see a lot of opportunity, the immediate opportunity that we see around DeFi and then digital currencies in terms of like the applications that can be developed for end consumers is a kind of a customer experience application services that some of the vendors are tapping into. We see some vendors like Infosys and TCS and Tech Mahindra partnering or investing in like a blockchain-enabled solutions with the Amazons of the world, or trying to think about where they can fit, where they can provide a value, that tap into their own value proposition from a low-cost perspective, or developing services as a service offerings within the blockchain. So there's a lot of moving pieces. One element that we see for vendors initially, at least, as they understand that there's a lot of shepherding needed, so to speak, the community participants, is offering those services on a pro bono basis, and kind of like show that and show that they can tolerate the risk themselves, and they can actually willing to think about where the opportunities will come from next and how they'll build up. On the technology side, on the blockchain side, there's a lot of platforms out there. There's a lot of noise, obviously, on the street right now for crypto, but from an enterprise standpoint, where the larger opportunities, the long-tail opportunities lay, we see three platform providers, blockchain providers, being really the go-to at the moment, like R3, Hyperledger, and Ethereum, with R3 being the one that's really thinking and investing in that more of a hybrid view where decentralized finance and centralized finance are starting to come together, addressing issues like privacies and so forth that are able to work towards more of a commonality. Hyperledger still a little bit more on the private blockchain, specific use cases for private blockchain. Ethereum with public blockchain, kind of like those are still more of a conventional in that sense, but R3 coming a little bit more in the middle, sort of a hybrid view of the world, providing the opportunity for hybrid use cases. Again, there's a lot. I'm rambling through all the good opportunities that are moving and pieces, but net, we certainly have started to see the sentiment towards blockchain warming up and changing. 6 months ago, we called blockchain was really going through a blockchain winter, the market. We're certainly seeing that banks are starting to say, well, it's a little bit more of a real thing. We're starting to see governments starting to think a little bit more and not just showing interest, but going through research, going through experimentation. As I said, someone like China going through the implementation and deployment of central bank digital currency like the digital yuan. So it's something that we'll continue to monitor and talk to both providers as well as all the community participants, kind of to understand where all those use cases outside financial services. There's some immediate areas that we see, like in the telecom industry and the e-commerce industry, is kind of providing the plumbing that may be required as the next best industries to adopt and embrace both the blockchain and decentralized finance, or some kind of a hybrid finance as a framework, as an option to drive opportunities at scale. But it's still a long way to go, and it's certainly something that we'll continue to do as part of our research to understand what about the personas and who are the participants, how do they think, how do they change their mindset, as we then put the bigger wrapper, what does it all mean in terms of digital transformation. We know cloud is important right now. Cloud drives the immediate revenue opportunities for many vendors. That's where a lot of the investments are happening. But Jeff pointed out, cloud on its own is, it's kind of boring. Same thing with blockchain. It's an opportunity for the vendors to start thinking about where can we actually, plug in blockchain to be actually augmenting existing processes and trying to make it more efficient. So a lot of moving pieces, but certainly a little bit more of a warmer sentiment, and we anticipate more of a push within the next 6 to 12 months in the blockchain, just because the way that crypto and digital currencies are becoming more about a killer app, so to speak, for the technology. I see we have a few more minutes for maybe for questions and answers here before we wrap up the webinar today. But Patrick, Jeff, anybody have any closing comments?
Yeah, let me just wrap up and say, Boaz, I think you pulled that together really well at the end in terms of linking the IT services space and the blockchain space and DeFi, because I think it's, for us, the story is not about the technology and it's not about the hype. It's about how the different vendors that we cover are going to include blockchain and DeFi within their offerings, how they're going to fold that into digital transformation for their clients, and where the pressure is coming from to do that. And part of the pressure is the need to grow, the need to continue to add clients to their roster. So here we see the coverage that we've talked about today from the IT services vendor benchmark, and you can see that list of all the vendors that are there, plus the almost obscene amount of metrics that we issue every quarter for IT services vendor benchmark. Here is the digital transformation research, and if you're on this webinar and you've got a specific question about a piece of this, please reach out and ask me. If you'd like to see the blockchain research that we've been talking about, please just shoot me an email and ask. Again, we published the first one in the springtime and the most recent one last month, and you can see the digital transformation portfolio is a monthly thing. And by the way, while I'm talking, my colleagues are getting ready to answer the questions that have come in the time we have left. This is within digital transformation. We also look at the innovation and transformation centers themselves. We did a webinar on that last week. If you want to listen in on that, it's very easy to find on the TBR website. And then again, here is the ways you can reach out and get a hold of each of us. I want to tackle a few of the questions that have come in. One of them is, how is Accenture's command and control culture driving their M&A success? The short answer is yes, it is. The longer answer is ask Boaz. So Boaz, what's your answer to that?
Yeah, real quick here. I mean, it's certainly 624,000 people organization right now. So they have learned how to manage at scale. And many of those acquisitions, while they may seem like, okay, well, 1,000 people or 500 people, a lot. I mean, they have a net hiring of, 15,000 people or more every quarter after quarter. So when you look at the grand scale scheme, certainly there's a lot of processes in place that enables Accenture to integrate. That's one thing. On the second part is that their rework around growth model, around Jew-specific P&L, what it enabled them also is to embed a lot of those acquisitions much easier, because very few of the acquisitions that they have pursued over the last several years have a global footprint. So having that regional presence and the way Accenture is organized at the regional level and the regional P&L have helped them also to easier to integrate those smaller tuck-in acquisitions. So that has certainly helped them to pairing with the overarching way of Accenture manages talent. It's a win-win for them when it comes to acquisitions. Again, put a little cautious here. Nobody's perfect. They certainly have seen their fair share of attrition, especially when it comes to some of the staff that never signed up to be part of big organizations. You have always people like this that are like, I'm part of the smaller company because they are small. I don't want to be part of a 600,000 plus organization. So naturally they're just going to leave. But generally speaking, those are the two factors that I spoke to that help them to be a little bit more efficient.
Excellent, thanks. And we have one more question I'll get to very quickly, and then Haley, if you can jump in and wrap us up. But it's the question, what can IT services vendors do to retain talent? Number one, focus on leadership. It's a changing generation. Everyone talks about what are the new folks coming in want, how do you work with these new generations? It's not it. It's about how you manage them. It's about how you lead them. The vendors that have focused on making sure, and I mean leadership at the very beginning, but all the way up to the top, the vendors that have focused on ensuring that their leadership is trained, has got the right tools, is empowered, is in position to do the right things by their people, those are the vendors that are retaining the talent. If you just focus on, what's the new special thing we can offer, or what's the new employee retention plan, or what's the new boost to productivity, or what's the new, special offer you can give, or compensation boost, that is not going to cut it. It really does come back down to leadership. So thank you all for listening in. Please send any additional questions to us. Haley, anything else to wrap up?
Yeah, like Patrick said, feel free to reach out to the team with any follow-up questions. And if you have a few moments, it would be greatly appreciated if you could fill out the survey that's going to pop up on your screen. A replay version of the webcast will be available after the event and will be sent to all of you via email. And be sure to join us on Wednesday, November 10th for how hardware vendors are ramping up subscription services to drive growth. Thank you all and have a great day.